Hey my friends, Barry Burns here with Top Dog Trading, and today I'm going to show you a demonstration on how to get a great risk-reward ratio by using multiple time frames. I like to use 3 time frames, and you can use any 3 that you want. This is not about which time frames you should use, but just for your reference, I'm using a 5-minute chart, a 15-minute chart, and a 45-minute chart. So we'll refer to these as short-term, medium-term, and long-term. Now, the way to do this, the key, the benefit of this is that we're going to take risk on the short term and take reward on the long term. And that's how we're going to get a great risk-reward ratio. So the short-term chart, the length of the bars is going to be very narrow length. So the width of these bars from high to low, let me actually get that off of there. So you can see these, all right? So if I enter on this bar, and again, I'm not teaching specific techniques here as trading. This is more the concept of risk reward on this. So you can apply this principle to any indicators or techniques or candlestick patterns you're using. But let's say you decided, for example, you wanted to use the MACD. We've got a higher low here, and we had a low and then a retest of the low, and then we're coming back up. MACD is coming above 0, the MACD histogram. Okay, got a cross of the MACD line and the signal line over here. And we had a nice 3-bar candlestick bottoming pattern here. All right, and increasing histogram on the long-term chart. So the concept is to say, all right, oh, and by the way, this yellow or white line here is my 15 exponential moving average. I use that as a line in the sand between a strong market, trending market, and one that is not trending strong. So you'll notice that I can take a very low risk trade here on the short-term chart. So if we pull this up here, for example, you'll see the high and the low there. And so we've got one 17,150, one 17,129. All right, that's the difference between the high and the low. On the other hand, if we were to go out here to one of these bars, you could do the math on your own there, or if we go even to the long-term bar, these tend to be even wider range because it's a 45-minute bar. So basically, the reason it's wider range is because it's the length of a bar from the low to the close that covers 45 minutes. Whereas this is the short-term chart, it's only the range of the bar within 5 minutes of price action. So generally, it's going to be a more narrow range bar. So if I enter above 1 pip above the high of this bar, put my stop 1 pip below the low of that bar, very narrow range, very low risk, but then my reward is over here. So look at this. If we come up, and let's say that I use, as I often do, I like to use the 15 EMA as kind of a trailing stop. So here we get down below it, and I'd get out. So that's going to be not a problem, but it does keep going up. And as it's coming down, we're giving back a little bit of unrealized gains if we get out and knock them into realized gains. All right, whereas with this pattern, if we use this pattern for our reward, we get to stay in all during this time, we don't get out until here. So big difference. Big difference. In fact, if I go over here and I change the scaling on the chart, you can get a better feel for how long this thing goes. In fact, we can go even a little bit further, I believe. Yep, we sure can. All right, and there you go. Let's see. Come on over here, looking at the times. And there we go. So if you look down here at the time, 6 to 6:30. Okay, 6 o'clock here, and that's when it really comes down and closes, clearly below the 15 EMA. Whereas if we use the short-term chart, we'd be getting out here at 2 o'clock. All right, but here at 2 o'clock, look, we're just getting started. We're just getting started. That's this bar here. That's why that bar has a high upper wick. But on this scale of the longer term chart, no problem, right? You look at this pattern, stay in, oops, out. Okay, if we got out here, we could have still stayed in, but look, then we get out here again, and it's harder to stay into these positions because visually it looks like more of a retrace, right, on this scale. And I mean, that is the truth on that scale. But again, the key is this: taking again your risk on the short-term chart, your reward on the long term. Now, you can take profits as you're going up, and I always do, by the way. I always do. So when I see this, I would go ahead and lock in some profits here. I do not scale in, by the way. So let's address that next. So I'd lock in the profits here, wait, probably lock in some profits there, lock in profits here, and have my trailing stop out there. Now, you got to be trading multiple contracts or shares in order to do this, obviously. So if you're only trading one contract, you don't have that flexibility in your money management, and that's a problem. That's makes it harder for people who can only trade one contract or one share. Now, why don't I size into trades? The reason I don't size into trades and I take profits as we go up instead of adding to my position is because adding to your position, that can look great as long as you've got a nice trend like we do here. So sure, that's great. That's the best case scenario, but the markets don't trend most of the time. So why would you do that when markets only trend, say, 20% of the time? So you're basing a trading methodology or a money management structure on adding to a position based on a structure, a trend, that only follows through 20% of the time. So that means adding to your position after a trend is already established is not going to serve you 80% of the time. The basic rule of trends is we want to get in early in a new trend because the trend is your friend until the end. And that's based on a statistical model that the longer a trend continues, the less likely it is to continue. So we only want to get in early, and I don't want to keep adding to my position because I'm adding as it becomes a lower and lower and lower probability trade. Just to me, silly. So anyway, that's a little concept for you. A lot of people like to use multiple time frames for confirmation of trades, and that's a good thing too, and I use them for that as well. But you can also use them for money management. So, by the way, if you want to get my indicator on how I time my entries to know exactly where to get in, I use this on the short-term chart especially, and I use this timing indicator to get into every single one of my trades, no matter whether it's a trend trade, trend reversal, triangles, head and shoulders, whatever it is, I use this indicator. It's an indicator, by the way, that's already on your charts, but I modify it. I've got my own little way of changing the parameters and the inputs and patterns on it to trade. So I don't do that webinar live anymore, but I did record it, and you can get the free recording. Just go ahead and go over there to indicatorwebinar.com and pick it up for free. And also, not only do I give that away for free, but I also give away one of my free trade strategies called the rubber band trade. So feel free to pick that up as well. And we'll be happy to give you that trading video, which is an actual complete trade methodology based on the reversion to the mean mathematical model. And I love, in fact, that's just the opposite of a trend trade. So, hey, guess what? Trends only follow through 20% of the time. Guess what happens the other part of the time? Reversion to the mean. Instead of moving away from the mean, which is what a trend is, it comes back to the mean. And I'll show you that. That's called my rubber band trade. So, hope you enjoyed this video. Leave any comments or questions below. Subscribe to the channel. And until the next one, happy trades.